If you are trading candle range theory, follow this method and win any trade. The typical concept of candle range theory usually involves 3 candles, and each candle has its own important role. The first candle defines the range. The second candle creates the sweep. The third candle provides the entry. We can actually use any candle that appears on a chart, and this applies to any time frame as well. If the second candle attacks the liquidity above the candle range high and immediately reverses, there's a high probability that the next target will be the liquidity below the candle range low. In other words, this liquidity sweep from the CRH suggests that the market is likely to shift direction and seek out liquidity resting at the opposite end of the range. If, instead, we see the second candle close above the CRH, then the potential candle range theory setup becomes invalid. This is because it's more likely that the market will continue pushing upward, rather than targeting the low of the first candle's range. However, if the criteria are met and the second candle fails to close above the candle range high, we can then look to the third candle for a potential short setup with our target being the candle range low.
Trading market is not easy. Market is always right, whether it's up or down. Be disciplined and patient for consistently good results. If you want to be a profitable trader, follow Cumin Room Trade.